Here's something that doesn't add up. More Americans are investing today than ever before in history. Robinhood, Fidelity, Vanguard, 60% of Americans now own stocks. Everyone's got a 401k, an IRA, a brokerage account. The financial literacy movement is booming. Everyone's building wealth. And yet, 78% of Americans still live paycheck to paycheck. Credit card debt just hit an all-time high of $1.13 trillion. Most people can't afford a $1,000 emergency. If everyone's investing, why is everyone still broke? The answer is going to expose the biggest scam in modern finance, and it's not what you think.
Hey everyone, welcome back to Capital and Power. Today we're asking the question nobody in the financial industry wants you to ask. If investing is the path to wealth, and more people are investing than ever before, why are most Americans still financially struggling? Because something's not adding up here. Every finance influencer says just invest in index funds. Every retirement expert says max out your 401k. Every book says build a diversified portfolio. And Americans are doing it. We're following the advice. We're being responsible.
But the results? They're not showing up in people's bank accounts. They're not showing up in reduced financial stress. They're not showing up in the ability to retire comfortably. By the end of this video, you'll understand the 5 reasons why investing alone won't save you, what the financial industry isn't telling you, and the uncomfortable truth about what actually builds wealth in America. Whether you're investing and still struggling, or you're wondering why the advice you're following isn't working, this video is going to change your perspective completely. And real quick, if you want content that questions the narratives instead of repeating them, hit that subscribe button. We're not here to sell you financial products. We're here to tell you the truth. All right, let's get into it.
Let's start by laying out the paradox clearly, because it's important to understand just how weird this is. The numbers. According to recent data, 61% of Americans own stocks, either directly or through retirement accounts. Over 100 million Americans have 401k accounts. The stock market has returned about 10% annually over the past decade. Total household investment accounts in the U.S. are worth over $35 trillion. So on paper, Americans are investing. The market's been going up. Wealth should be building, right? But here's the other side. 78% of Americans live paycheck to paycheck. 64% couldn't cover a $1,000 emergency without going into debt. Credit card debt is at $1.13 trillion, all-time high. Student loan debt is $1.77 trillion. The median retirement savings for Americans aged 55 to 64 is only $120,000, not enough for retirement. 55% of Americans have no retirement savings at all. How is this possible? How can the majority of Americans be investing while simultaneously being financially insecure? Let me give you a real scenario. Meet Sarah. She's 35, makes $65,000 a year. She contributes 6% to her 401k, $3,900 a year. Her employer matches 3%. She's doing everything right.
Her 401k balance? $47,000. Sounds good on paper. But she also has $32,000 in student loans at 6% interest, $8,000 in credit card debt at 22% interest, $18,000 car loan at 7% interest, 0 emergency fund, can't afford a down payment on a house, lives paycheck to paycheck despite her investments. This is millions of Americans investing and broke. How? The answer is uncomfortable, but it's time we talked about it. The first reason investing isn't saving most Americans. The amounts are too small, and they started too late. Let's do the actual math that the financial industry doesn't want you to focus on. The retirement reality. Financial advisors say you need about $1 million to retire comfortably. Some say $1.5–2 million, depending on your lifestyle. Let's use $1 million as the baseline. To get to $1 million by age 65, Assuming 8% annual returns, generous, here's what you need to invest. Starting at age 25, $286 per month for 40 years. Starting at age 35, $671 per month for 30 years. Starting at age 45, $1,698 per month for 20 years. Here's the problem. The average American doesn't start seriously investing until their mid-30s. And the median contribution to 401ks is only $3,000, $4,000 per year. That's $250, $333 per month. Do the math. $333 per month starting at age 35 gets you to about $500,000 by 65, not $1 million. And that's assuming no interruptions, no job loss, no emergencies, no life events. Consistent 8% returns, not guaranteed. No early withdrawals. Most people tap retirement accounts in emergencies. The harsh reality: most Americans are investing amounts that mathematically cannot provide financial security, and they started too late for compound interest to really work its magic.
The wealth gap. Meanwhile, the wealthy are investing massively. The top 10% of Americans own 89% of all stocks. The bottom 50%? They own just 1% of stocks. So yes, everyone is investing, but the amounts are so different that the outcomes are completely different. You're contributing $4,000 a year to your 401k and think you're building wealth. Someone else is investing $100,000 a year across multiple accounts, real estate, businesses, and alternative investments. You're both investing, but you're playing completely different games. The catch-up trap. Because most Americans start late with small amounts, they're always playing catch-up. They never get ahead. They're investing, but they're investing just enough to not have zero, not enough to actually build life-changing wealth. This is by design. The financial industry wants you investing just enough to need their services forever, but not enough to actually become financially independent. Here's the second brutal truth. You're investing money on one side while losing more money to debt on the other side. Remember Sarah from earlier? She's investing $3,900 per year in her 401k, earning maybe 8% returns. That's $312 per year in growth. But she's also paying $1,920 per year in student loan interest, 6% on $32,000. $1,760 per year in credit card interest, 22% on $8,000. $1,260 per year in car loan interest, 7% on $18,000. Total interest paid, $4,940 per year. She's earning $312 from investments, but losing $4,940 to debt interest. Net result? She's going backwards $4,628 every year. But the financial advice says start investing early. So she's investing while drowning in debt, thinking she's being responsible. This is the scam. The same industry that sells you investment products also sells you debt products. They profit both ways. You lose both ways. The debt cycle. The average American household has $21,800 in non-mortgage debt. Average interest rate, 15 to 20%. Minimum payments that barely cover interest. So they're trapped. They can't invest more because they're buried in debt. But they invest what they can because that's what you're supposed to do. And they never get ahead because the debt interest eats the investment gains. The math never works. If you're earning 8% on investments, but paying 20% on credit card debt, you're losing 12% on every dollar. Yet Americans are doing exactly this. Why? Because the financial industry teaches you to do both. Invest for your future and take out loans for college, cars, homes, emergencies. They make money on both ends, while you stay trapped. The uncomfortable truth? You should pay off high-interest debt before investing. But that advice doesn't sell financial products, so you rarely hear it. The third reason, even when your investments grow, your spending grows faster. This is called lifestyle inflation,
and it destroys wealth silently. Here's how it works. You get a raise. Your income goes from $50,000 to $60,000. You're making $10,000 more per year. Great. But then, you upgrade your apartment. $200 a month more. You buy a nicer car. $150 a month more. You eat out more often. $200 a month more. You upgrade your phone plan, streaming services, gym membership. $100 a month more. You take nicer vacations. $2,000 a year equals $167 a month. Total new expenses, $817 a month equals $9,804 per year. You got a $10,000 raise, but you increased your spending by $9,800. Your ability to invest increased by only $200 per year. Meanwhile, your investments might be growing at 8%, but if you're adding almost nothing in new contributions, the growth is marginal. The hedonic treadmill. Psychologists call this the hedonic treadmill. As you earn more, you want more. Your lifestyle expands to match your income. You never actually get ahead. You just have nicer stuff while staying equally broke. The wealthy understand this. They increase income but don't proportionally increase lifestyle spending. The gap between earning and spending is where wealth builds. Most Americans increase lifestyle spending faster than income grows. That's why they're investing, but still struggling.
The status trap makes this worse. You see others living certain lifestyles. You feel pressure to keep up. You finance the lifestyle you can't afford, while investing the bare minimum to check the responsible adult box. The result? Investments that grow slowly, while fixed expenses lock you into needing that paycheck forever.
Fourth reason, not all investing is actually investing. The financial industry has convinced Americans that putting money in a 401k or buying stocks is investing. But there's a massive difference between passive investing, what most Americans do, buy index funds through employer retirement plan, let it sit for decades, hope it grows enough by retirement, no control, no active involvement, returns capped at market rates, 8 to 10% average. Active wealth building, what wealthy people do, invest in businesses they control or influence, buy real estate that generates immediate cash flow, invest in themselves, skills, education, networks, create multiple income streams, build equity in appreciating assets. Typical returns 15 to 30% plus because they're actively creating value. Here's the difference. When you buy an index fund, you're betting on other people's businesses growing. You have zero control. You're a passenger. When you invest in real estate, start a business, or build valuable skills, you're actively creating wealth. You're the driver. Most Americans are passengers, wondering why they're not getting anywhere fast. The asset class divide. The wealthy diversify across stocks, 20 to 30% of portfolio, real estate, 30 to 40%, private businesses, 20 to 30%, and alternative investments, 10 to 20%. The average American has stocks, 90% through 401k or IRA, maybe a primary residence, not generating income. The time horizon trap. 401k investing is designed for 30 to 40-year time horizons. That's great for retirement, but it does nothing for your financial security today. You're investing for your 65-year-old self while your 35-year-old self is struggling to pay bills. The wealthy invest in things that generate cash flow now, rental properties, dividend stocks, businesses. They build wealth that helps them today, not just decades from now. Here's the final, most uncomfortable truth. The financial system isn't designed to make you wealthy. It's designed to keep you working. Think about it. The 401k system. Created in 1978 as a tax loophole, it became the primary retirement vehicle for Americans. But here's what it does. Locks your money away until 59.5. Early withdrawal equals penalties. Limits contributions, $23,000 per year max in 2024. Forces you to buy financial products, mutual funds with fees.
keeps you dependent on employers for matching contributions, and requires you to work for 40+ years to accumulate enough. It's a golden cage. It's better than nothing, but it's specifically designed to keep you working your entire life. The wealth extraction model. Every step of the way, the financial industry extracts fees. Management fees, 0.5 to 1% of your balance annually. Trading fees, expense ratios on funds, advisory fees, tax penalties if you try to access your own money early. Over 40 years, these fees can consume 20 to 30% of your returns. You're working hard, your money's growing, but a huge chunk goes to Wall Street. The real purpose. The system isn't broken. It's working exactly as designed. It keeps the masses investing just enough to not revolt, but not enough to actually become financially independent and leave the workforce. You're a productive worker generating value for 40 years, with just enough investment to feel like you're getting ahead, while never actually accumulating enough to be free. That's why everyone is investing and everyone is still struggling, because the game is rigged to produce exactly this outcome.
So what's the solution? If traditional investing isn't enough, what should you do? Strategy 1. Eliminate high-interest debt first. Stop investing while paying 20% credit card interest. The math doesn't work. Pay off debt aggressively, then invest. You'll build wealth faster. Strategy 2. Build multiple income streams. Don't depend solely on your job plus passive investments. Create side income through freelancing your skills, small business ventures, and income-producing assets like rental property or dividend stocks. Strategy 3. Invest in income-producing assets. Shift from pure growth stocks to assets that pay you now. Real estate with positive cash flow, dividend-paying stocks, businesses you can build and grow. Strategy 4. Invest in yourself. Your earning power is your greatest asset. Invest in skills that increase your income, education that opens new opportunities, networks that create opportunities, and your health. Sick and tired equals can't build wealth. Strategy 5. Break free from the 401k only mentality. Yes, contribute enough to get employer match, free money, but don't stop there. Build wealth outside retirement accounts so you have freedom and options today. Strategy 6. Live below your means permanently. This is unsexy but essential. Keep lifestyle inflation in check. The gap between earning and spending is where wealth builds. If this video made you rethink everything you were taught about investing, hit that like button. And if you want more content that questions the financial narratives instead of repeating them, subscribe and turn notifications on. Now here's my question. Which of the 5 reasons hit home for you the most? Comment the number 1 to 5 and tell me which one describes your situation. Let's see if there's a pattern in this community. Also, are you investing but still struggling? Drop a yes or no in the comments. I want to see how many of us are living this paradox. Thanks for watching. Stay critical, stay educated, and I'll see you in the next video where we're breaking down why financial freedom is being sold as a product instead of taught as a skill. Peace.